Introduction to Asset-Backed Securities Summary. First, let's understand the securitization process and the participants involved. Say there is a financial institution, and we'll call it X. This financial institution owns several mortgage loans. X then sells these mortgage loans to another entity called SPV. So these mortgage loans are sold, and then SPV owns the mortgage loans, and with these mortgage loans as collateral, the SPV issues securities. These securities are called asset-backed securities, and they are backed by these mortgage loans. Now, in this scenario, the seller of the pool of securities is X. It's called the seller. It's also called the depositor. The special purpose vehicle is the entity that buys the mortgage loans and issues the asset-backed securities. The SPV is also called the trust, and note that the SPV is a bankruptcy remote vehicle. What that means is once these loans are sold to the SPV legally owns these loans or these assets, and no matter what happens to X, the claims that these investors have are against the SPV's assets. So if this entity goes bankrupt, that does not impact the investors who bought these asset-backed securities. Now, in this process, there needs to be an entity that collects payments. So these are loans, and some entity needs to collect the money, collect the funds. That entity is called the servicer. The servicer could be the original seller of the pool of securities, it could be the special purpose vehicle itself, or it could be a third party that is hired to act as the servicer. There are other players also involved, such as lawyers and maybe a trustee, but these three players are the major participants in the securitization process. Now let's understand the benefits of securitization. Number one, securitization enables investors to get direct access to liquid investments and payment streams that would be otherwise unattainable. So notice that through this process, the holders of these securities get access to payments associated with these mortgage loans. Securitization enables banks to increase loan origination, monitoring, and collections. This happens because securitization enables lower cost of borrowing for entities raising funds. It also leads to higher risk-adjusted returns to investors and greater efficiency and profitability for the banking sector. If we look at the entire universe of asset-backed securities, the largest segment or the largest sector would be mortgage-backed securities. Within mortgage-backed securities, perhaps the biggest component would be residential mortgage-backed securities. Now, residential mortgage-backed securities are backed by residential mortgage loans, so it is important to understand a few things about residential mortgage loans. A mortgage loan is a loan secured by the collateral of some specified real estate property which obliges the borrower to make a predetermined series of payments to the lender. So if you have Mr. and Mrs. Smith who buy this house, they go to a bank and they borrow money from the bank to buy the house. The house is the collateral, and the mortgage loan then becomes an asset for the bank. So this is the mortgage loan that we are talking about. The cash flow of a mortgage loan includes interest, scheduled principal payments, and prepayments. So obviously Mr. and Mrs. Smith then make payments to the bank, and we are saying that the payments that they make have these three components: the interest component, the scheduled principal component, and prepayments. Prepayments refer to the principal payment which is made. Prepayments refer to the principal which is repaid in excess of the scheduled principal. The ratio of the property's purchase price to the amount of the mortgage is called the loan to value ratio. So if the house is worth 100,000 and the loan is 80,000, then the loan to value ratio is 80 over 100 or 0.8. With these mortgage loans, there are several important elements. So there is maturity. A mortgage loan might be a 30-year loan. So we'd say that the maturity is 30 years. Different mortgages will have different types of interest rates. So there might be a fixed interest rate. There might be mortgages with variable interest rates and so on. There will be an amortization schedule which indicates how the principal will be paid back. There might be prepayment penalties, or in some countries there are prepayments without any penalties. We as analysts need to understand whether prepayment penalties exist for the underlying mortgage loans. We also should understand the rights of the lender in a foreclosure. And here we have either recourse mortgage loans and non-recourse mortgage loans. What this means is if Mr. and Mrs. Smith cannot make payments to the bank for some reason, then the bank in essence takes charge of the property. If the loan is a recourse loan, this means that the bank can go after the other assets of Mr. and Mrs. Smith. If this is a non-recourse mortgage loan, then the bank only gets the house and cannot go after the other assets of Mr. and Mrs. Smith. Alright, now that we've understood mortgage loans, let's look at residential mortgage-backed securities. Bonds created from the securitization of mortgage loans for the purchase of residential properties are residential mortgage-backed securities, generally referred to as RMBS. Now, in the example that I gave a couple of slides ago, I essentially spoke about residential mortgage-backed securities because there I talked about a pool of mortgage loans or residential mortgage loans being securitized, and then if securities are issued with these mortgage loans as collateral, then we have a residential mortgage-backed security. Within RMBS, we have three sectors. Number one, those guaranteed by a federal agency whose securities are backed by the full faith and credit of the US government. So here we are taking a United States centric view, and that makes sense because in terms of the MBS market, the United States is by far the biggest. The second is those guaranteed by either of the two government sponsored entities, and those two entities are Fannie Mae and Freddie Mac. So they are guaranteed by a government sponsored entity but not by the US government itself. Generally, category 1 and 2 are bundled together and referred to as agency mortgage-backed securities or agency bonds, and here the credit risk is essentially zero. Then we have securities which are issued by private entities that are not guaranteed by a federal agency, and here credit risk does exist. These are called non-agency bonds. Over the next few slides we'll talk about agency bonds, and then we'll move to non-agency bonds. Let's talk about the most basic type of a mortgage-backed security, which is a mortgage pass-through security. And here we are in the world of agency bonds, so credit risk is not going to be discussed. A mortgage pass-through security is created when one or more holders of mortgages form a pool of mortgages and sell shares or participation certificates in the pool. So this is what we've been talking about. So there is an entity that owns a pool of mortgage loans and then sells securities which are backed by this pool of mortgage loans. So what are the cash flow characteristics here? The cash flow that is received by the investors includes interest payments, scheduled repayments, and prepayments. And this is simply coming from the mortgage loans. So the homeowners are making payments. Those payments made by the homeowners have these three components, and those payments are passed through to the security holders. There is this concept of a pass-through rate. Let's say that on average these mortgage loans have a rate of 8.5%, but the financial institution in the middle is going to charge a certain fee. Let's say that that fee is 0.5%. So the pass-through rate for the security holders is 8%. And from an investor perspective, this is the number that matters. It is essentially the net rate that investors get. Weighted average coupon refers to the average coupon rate of all these securities. So we need to weight the coupon rates based on the value of each of these mortgage loans, and when we come up with that weighted average, that is referred to as weighted average coupon. To take a real simple scenario, let's say that all these mortgage loans to take a simple example, let's say that all these mortgage loans have a mortgage rate of 6%, then the weighted average coupon will be 6%. If half have 6%, the other half have 7%, and both have equal market value, then the weighted average coupon will be 6.5. Similarly, we have weighted average maturity, where we look at the maturity of all these mortgage loans and find the weighted average. The concept of conforming and non-conforming loans is important. So when we say conforming loans, that means that a loan conforms to the rules of an agency. So to be part of a pool which is supporting an agency asset-backed security, the loan needs to meet certain criteria, and if it does, then it's called a conforming loan. If it doesn't, then it's called a non-conforming loan. As an example, for a conforming loan, the loan to value ratio would need to be below a certain specified number. Investors in mortgage-backed securities are concerned about how fast prepayments are being made. So let's look at some measures of prepayment rate. The most basic measure is called single month mortality, or SMM. This measures prepayments in a month. SMM is equal to prepayment for month divided by beginning mortgage balance for the month minus scheduled principal repayment for the month. So take a simple example. Let's say that the beginning mortgage balance is 102, the scheduled principal repayment is 2, and then the prepayment, let's say, is 3. So the SMM is going to be 3% in this case. Then we have the conditional prepayment rate, or CPR. This is an annualized version of the SMM. Note that SMM is a monthly number because we are talking about the prepayment for a month relative to the outstanding principal. CPR takes the SMM and annualizes the number. Let's understand the interpretation of CPR. A CPR of 6% means that approximately 6% of the outstanding mortgage balance at the beginning of the year is expected to be prepaid by the end of the year. 100 PSA prepayment benchmark is expressed as a monthly series of CPRs. Now you don't need to understand the details here, just recognize that 100 PSA represents a certain prepayment rate. Now if we assume that the PSA is, say, 150 PSA, so you have one security where the rate is 100 PSA, and another security where the rate is 150 PSA. With this security, the prepayments are faster. So the higher the number, the faster the prepayments, and a lower number means slower prepayments. The weighted average life or average life gives investors an indication of how long investors can expect to hold the MBS before it is paid off. So let's say that if the PSA assumption is 125 and the average life is 10.1, then a lower PSA will mean that the average life goes up, and a higher PSA means that the average life comes down. Contraction risk is the risk that when interest rates decline, the security will have a shorter maturity than was anticipated at the time of purchase, because homeowners refinance at now available lower interest rates. So let's say that initially the assumption was 100 PSA, and then interest rates fall. When interest rates fall, homeowners refinance, which means that the original loans are paid off faster. So the actual prepayment rate will go higher than what was initially anticipated. A higher prepayment rate means that the life of the security will come down. The risk of this happening is called contraction risk. Extension risk is the risk that when interest rates rise, fewer prepayments will occur, because homeowners are reluctant to give up the benefits of a contractual interest rate that now looks low. Coming now to collateralized mortgage obligations. The creation of a CMO can help manage prepayment risk by distributing the various forms of prepayment risk among different classes of bondholders. For CMOs, the collateral is usually a pool of mortgage pass-through securities. So earlier we talked about a pool of mortgage loans, and against this pool, securities were issued which were called mortgage pass-through securities. Now our pool consists of mortgage pass-through securities, and against this pool we have CMOs. And the idea is that these CMOs are created such that we have different bond classes, and the prepayment risk that we talked about earlier, which is associated with mortgage pass-through securities, is redistributed across the different bond classes in a CMO. The creation of a CMO cannot eliminate prepayment risk. It can only distribute the various forms of this risk among various classes of bondholders. The CMO's major financial innovation is that the securities can be created to closely satisfy the asset liability needs of institutional investors, thereby broadening the appeal of mortgage-backed products. The most common types of CMO tranches or CMO bond classes are shown here. We can have sequential pay tranches, and what happens here is that the different bond classes or tranches are created such that certain tranches receive prepayments faster, whereas other tranches receive prepayments later. Then we can have planned amortization class tranches. Here both extension risk and contraction risk is contained, which means that there is greater certainty about the life of the security. This greater certainty comes at the expense of support tranches, which take on more prepayment risk. So support tranches have higher extension and contraction risk, and packed tranches have relatively low extension and contraction risk. We can also have floating rate tranches where the rate associated with the bond class or tranche depends on the interest rate. Coming now to non-agency residential mortgage-backed securities. Everything that we discussed so far was relevant for agency securities, and with agency securities there is essentially no credit risk. Now the big difference will be that we will also have to worry about credit risk. Non-agency residential mortgage-backed securities typically include two complementary mechanisms. Number one, the cash flows are distributed by rules such as the waterfall that dictate the allocation of interest payments and principal repayments to tranches with various degrees of priority or seniority. And two, there are rules for the allocation of realized losses which specify that subordinated bond classes have lower payment priority than senior classes. So you'll notice in the curriculum that wherever we have subordinated bond classes, the credit risk tends to be higher, so the expected rate associated with these classes tends to be higher. In order to obtain favorable credit rating, non-agency RMBS and non-mortgage asset-backed securities often require one or more credit enhancements. So credit enhancements can be internal, and the major types of internal credit enhancements include the following: a senior subordinated structure, reserve funds, and over-collateralization. External credit enhancements include financial guarantee by a third party such as a monoline insurance company. The most common type of an external enhancement is a financial guarantee by a third party such as a monoline insurance company. Commercial mortgage-backed securities are securities which are backed by a pool of commercial mortgage loans on income-producing property. Generally, commercial mortgage loans are non-recourse loans, hence credit analysis involves studying the cash flows from the underlying properties. Two key indicators of the potential credit performance include: number one, debt to service coverage ratio, and the loan to value ratio. So loan to value ratio, as we discussed earlier, is the loan amount divided by the value. So a low loan to value ratio will be good, and the coverage ratio, higher the better. So high coverage ratio and low loan to value ratio would imply good credit, or would lead to a high credit rating. A credit rating agency determines the level of credit enhancement necessary to achieve a desired credit rating. For example, if specific DSC and LTV ratios are needed and those ratios cannot be met at the loan level, subordination is used to achieve the desired credit rating. So subordination is an internal credit enhancement mechanism where we have different bond classes, and subordinate bond classes absorb losses first, so these will have low ratings, and the bond classes that have protection will have higher ratings. Losses arising from loan defaults are charged against the principal balance of the lowest priority CMBS tranche outstanding. This tranche may not be rated by credit rating agencies. In this case, this unrated tranche is called the first loss piece, or the residual tranche, or equity tranche. Call protection and balloon risk. Commercial mortgage-backed securities have considerable call protection. Call protection comes in two forms: at the structure level and at the loan level. An example of call protection at the structure level is sequential pay tranches. So let's make sure we understand this. So say we have four bond classes A, B, C, and D, And if we say that prepayments go first to class D, then C, then B, so notice that in this scenario, in essence, A is getting a fair amount of protection. At the loan level, four mechanisms offer call protection, and those are shown here. Prepayment lockouts. So with the underlying loan, the borrowers might not be able to make prepayments or might not be allowed to make prepayments for a certain period. There might be prepayment penalty points or yield maintenance charges. So basically these discourage the borrowers from making prepayments or defeasance. Many commercial loans backing CMBS transactions are balloon loans. Many commercial loans which serve as collateral for commercial mortgage-backed securities Many commercial loans backing CMBS transactions are balloon loans. So balloon loans are loans where the principal is due at the end. The risk that a borrower will not be able to make the balloon payment because either the borrower cannot arrange the risk that a borrower will not be able to make the balloon payment because either the borrower cannot arrange for refinancing or cannot sell the property to generate sufficient funds to pay off the balloon balance is called balloon risk, and balloon risk is a type of extension risk. Auto loan receivable backed securities. Now these are securities that are backed by auto loans. The cash flow consists of interest payments, scheduled principal repayments, and any prepayments. Prepayments result from sales and trade-ins requiring full payoff of the loan, repossession and subsequent resale of vehicles, insurance proceeds received upon loss or destruction of vehicles, payoff of the loans with cash to save on interest cost, and refinancing of the loans at a lower interest rate. All auto loan backed securities have some form of credit enhancement. One example might be a senior subordinated structure. So the senior tranches have credit enhancement. In other words, if there are losses, the losses are absorbed first by the subordinated bond classes. Or there might be a reserve account or over collateralization, and there might be excess interest on the receivables. This simply means that those who buy the car and borrow money pay a relatively high interest rate compared to what the investors get. Credit card receivable backed securities. Credit card receivables are used as collateral for the issuance of credit card receivable backed securities. For a pool of credit card receivables, the cash flows consist of finance charges collected, fees, and principal repayments. Finance charges collected represent the periodic interest the credit card borrower is charged on the unpaid balance after the grace period. Fees include late payment fees and any annual membership fees. Interest is paid to security holders periodically, either monthly, quarterly, or semi-annually. The interest rate may be fixed or floating. Credit card receivable-backed securities are based on non-amortizing loans. With non-amortizing loans, there isn't a requirement to make principal payments. They have lockout periods during which the cash flow that is paid out to a security holder is based only on finance charges collected and fees. When the lockout period is over, the principal is no longer reinvested but paid to investors. So during the lockout, if any prepayments are made, then those principal payments are used to issue more loans. And finally, we come to collateralized debt obligations. A CDO is a generic term used to describe a security backed by a diversified pool of one or more debt obligations. So these might be corporate bonds, emerging market bonds, leveraged bank loans, asset-backed securities, various types of mortgage-backed securities, or other CDOs. Like an ABS, a CDO involves the creation of a special purpose vehicle, but in contrast to an ABS, where the funds necessary to pay the bond classes come from a pool of loans that must be serviced, a CDO requires a collateral manager to buy and sell debt obligations for and from the CDO's portfolio of assets to generate sufficient cash flows to meet the obligation of the CDO bondholders and to generate a fair return for the equity holders. The structure of a CDO includes senior, mezzanine, and subordinated equity bond classes. In the case of defaults in the collateral, there is a risk that the manager will fail to earn a return sufficient to pay off the investors in the senior and mezzanine tranches. Investors in the subordinated equity tranche risk the loss of their entire investment.